Good afternoon, everyone. I'm Rahul Modi, and I'm here to present my group's project on Dow Jones Industrial Average Index analysis. My group members are Sankir and Ali. Our project's problem statement is to find the relation and effect of stocks on DJIA. First, let's talk about data extraction. In data extraction, we have extracted two data sets. The first one being made up of all the closing prices of all the stocks in DJIA. This data dates back to 1st September 2020. The second data set is of DJIA Index closing price. This data set dates back to 3rd January 1984. Now let's come to the analysis part of the project. In analysis part, we have first perform portfolio analysis. In portfolio analysis, we have first compared all the cumulative growth of each and every single share with respect to the market benchmark. We have plotted a line graph, and in line graph, we have basically made a stock returns versus market graph. We can see that there are stocks like Chevron Corp that have performed better than the market benchmark. We were also able to find out weaknesses and strengths in the market. Uh, Stocks like Visa Inc., Honeywell, and Home Depot being the strengths, whereas stocks like Disney, 3M, and Walgreens being the weakness of the market. This data, this analysis is based off the market share that each and every single stock has and the way they have grown over the year. Then we had plotted a correlation graph. In correlation graph, we were able to find out the most correlated stocks like Cisco, Goldman Sachs, and JP Morgan. We were also able to find out negatively correlated stocks like Verizon. In previous analysis, we didn't mention it because we didn't knew that it is negatively correlated, but Verizon is also a stock that has performed below the benchmark of the market. We were also able to find out that company stocks like Disney, 3M, and Walgreens that we thought were weakness of the market have actually shown an independent correlation to the market, which means that any investor who is investing in this portfolio can hedge his risk accordingly because he also has independent movement stocks. Then we had performed a beta analysis. In beta analysis, we were trying to find out if there are stocks which are volatile and non-volatile, and if there are any stable investment options. Firstly, we see stocks like Boeing, American Express, Salesforce, Disney have high volatility. That means these stocks have high risk, but also have high rewards during upturn. Then we were able to see stocks like Cisco, 3AM, IBM, Coca-Cola. These stocks have more stable environment, but they might not return the same. They might not have the same returns as Boeing or American Express during the upswings. Lastly, there are stocks like Merck, which have beta less than 0.5. This kind of stocks are there to offer stable investment, but potentially you might miss out on opportunities during a bullish market. Then we had performed a portfolio analysis of a portfolio without Verizon stock that we had said is a weak point of the market with respect to the market benchmark. We had again made a line graph and plotted the cumulative growth of returns basically of portfolio without Verizon and the benchmark. And we see that the portfolio without Verizon performs very well with respect to the benchmark. Then we have also done a Bollinger Bands test. We have taken two analysis. That one is short-term analysis, which has 20 days of moving average with standard deviation of 2, and one is long-term analysis, which has 50 days of moving average with standard deviation of 2.5. We find a similar result in both of these analysis, with none of the stocks breaking any lower bounds, which means that none of the stocks have been overbought by us. But some of the stocks do break the upper bound, like Boeing or CAT or JP Morgan Chase. This basically means that we might have overbought these stocks and we might have to consider hedging these stocks. This is the short-term result. This is the long-term analysis result. Then we had made a LSTM model. In LSTM model, we have taken the stock price since the start of DJIA Index since 1998. And we can see that the index has grown exponentially and has shown a great growth over the years. We have then compared rolling mean and rolling standard with respect to the closing price of the index over the years. And then we had decomposed the data to see if there are any hidden trends in the index, if there has been any seasonal changes in the index, anything. But we can see that the trends basically show the same plot as to the closing price. And in seasonal, we can see that it fluctuates very often and with a high rate. That means there are no seasonal or any hidden trends in this index. We had also created an RIMA model, which is basically to compare with our LSTM model's results. This is just for seeing which model suits this index better. This is the result of our LSTM model predictions. And we can see that the predictions are pretty close to the closing value. And we had also made sure we are trying to predict the 7th day value rather than the next day value. Now, for conclusions, we can conclude that Verizon is proving to be not a good thing for the portfolio, whereas excluding Verizon, you might get more returns and with 47.46% and more annualized returns of 13.28%. But since Verizon is the only telecommunication company in the index and it also has 0.67% of the index, it might be better for strategically relocating it to another telecommunication company, which shows a strong correlation with the index. Furthermore, we can say that uh, stocks like Doing, Goldman Sachs, Boeing, American Express uh, have shown overbought conditions. So one might think about hedging them. Lastly, the LSTM model that we had created has demonstrated a superior forecasting capabilities with respect to the ARIMA model and any other model, with a lower MSC of approximately 848,586.39 and root mean square error of 921.19 on the test set. Thank you.